If you had invested in the right assets in the United States over the past 10 years, you wouldn't have to work anymore. While many people were trying to catch the next big thing, these assets were there, delivering returns year after year. These aren't bets, they're choices the wealthiest Americans actually made, and they worked. Today, I'm going to show you the 5 assets that have made Americans the richest over the past decade, with a question at the end: will they continue to rise? Let's dive in. But don't forget to subscribe to our community if you like this video. If you don't like it, you don't have to. But if you do, you know what to do. The best performing asset of the past 10 years wasn't a stock, it wasn't real estate, it wasn't gold. It was Ethereum, a decentralized open source network most people still don't fully understand. In August 2015, you could buy 1 ETH for around $0.70. Today, it's trading at over $3,280. That's a 4,680 times return. A $1,000 investment would be worth $4.68 million today, and that happened in less than a decade. But here's what's important: this didn't happen because of hype, as many people think. It happened because Ethereum became infrastructure. It's the backbone of decentralized finance. It's where smart contracts run, where NFTs were born, where lending, staking, trading, tokenization all happened without intermediaries. Bitcoin might be digital gold, but Ethereum, it's the financial internet. There's no CEO, no headquarters. It runs 24/7 across borders with no permissions needed. And as it matured, it got leaner. In 2022, Ethereum moved from proof of work, mining, to proof of stake, reducing energy consumption by over 99%. New token issuance dropped sharply. In some periods, more ETH was burned than created, making it potentially deflationary. This isn't just a coin, it's programmable money, and the rails for an entirely new financial system. But now, the obvious question is, can it keep going? And the honest answer is, not like before. The exponential growth is unlikely to repeat. Why? Because it's already known. It's already held by institutions. It's being considered for ETFs. It's no longer early. Future growth will depend less on speculation and more on real-world adoption, scalability, and regulatory clarity, and that brings the risks, like regulation. ETH could be classified as a security in the US scalability because it still struggles with high fees and congestion. Competition. Other chains like Solana, Avalanche, and Layer 2s are advancing fast, and complexity. The technology is still hard for the average user to grasp or use. You may not even understand many of the terms I just used. So here's the logic. Yes, Ethereum changed the game. Yes, it made millionaires. And yes, it may still have room to grow, but no, it's not risk-free. And no, it's not a guaranteed repeat of the past. Now, moving to the next one. If Ethereum became the infrastructure, Bitcoin was the spark. The first crypto, the most controversial, and the best performing asset for most of the past decade. Back in July 2015, Bitcoin was trading at around $293. Today, it's hovering near $120,000. That's a 420 times return. A $1,000 investment back then would now be worth $420,000, $10,000, over 4 million. People who believed early, some of them became legends. Guys like the Winklevoss twins, who took part of their Facebook settlement and put it into Bitcoin back in 2013. By 2017, they became the first known Bitcoin billionaires. Or Michael Saylor, CEO of MicroStrategy, who turned his software company into a vehicle to accumulate BTC, buying over $6 billion worth and turning the company's stock into a proxy for Bitcoin. There's also Eric Finman, who bought Bitcoin at age 12 with a $1,000 gift from his grandmother and became a millionaire before turning 18. And while most people laughed, these guys held on. Bitcoin was called a bubble, a scam, a joke. It was banned, ridiculed, attacked, and yet it survived and scaled because Bitcoin is not a company, it's not a person, it's code, it's math, it's scarcity. Only 21 million BTC will ever exist. That number is hard-coded, and over 90% has already been mined. Every 4 years, something called a halving occurs, cutting the new supply in half. Historically, every halving has triggered a major bull run. 2012 halving, massive surge 2016 halving, another surge 2020 halving, all-time highs, again 2024 halving, now underway. But here's the nuance. Each cycle is becoming less explosive. The earlier you were, the more dramatic the upside. Now the market is maturing. Institutions are buying, ETFs have been approved, family offices and sovereign wealth funds are getting exposure. So is there room to grow? Yes, but probably not another 1,000 times. Today, Bitcoin plays a different role. It's shifting from high growth to long-term store of value, a kind of digital gold, but more portable, divisible, and auditable. And in a world where fiat currencies are constantly devalued, having exposure to a fixed supply asset might not be optional. It might might be necessary. Still, let's be clear. Bitcoin is not risk-free. Here's what you need to consider. Bitcoin is a very volatile asset. It has its challenges and risks, but I think it's very important to make it clear here that you shouldn't invest in it if you don't believe in its capabilities. Understand? You can't just invest, cross your fingers, and hope for growth. Don't do that. You have to invest because you believe the project is good and valuable. So, is it still worth it? If you're looking for instant gains, probably not. But if you want exposure to a truly scarce, decentralized, global asset that can't be printed, frozen, or inflated, there might not be anything more asymmetric. Now moving to the top 3. Maybe you've never heard of this asset really, but XRP was one of the best performing crypto assets of the past decade, though its trajectory was inconsistent and marked by legal uncertainty. In July 2015, the price of one XRP was around $0.081. By July 2025, it trades near 2.96. That's a 360 times return, meaning a $1,000 investment would be worth roughly $36,000 today. Unlike Bitcoin or Ethereum, XRP was not designed to be decentralized or mined. The entire 100 billion supply was pre-mined, with Ripple Labs, the company behind the protocol, retaining a large portion from the start. The initial promise of XRP was that it could be used as a bridge currency in global financial transactions, allowing banks and payment providers to settle cross-border payments faster and cheaper than through SWIFT. In the early years, XRP gained momentum as Ripple Labs partnered with several financial institutions for pilot programs. Much of the retail demand in 2017 and 2020, however, came from speculation, not from proven adoption. That speculation was disrupted in 2020 when the U.S. Securities and Exchange Commission filed a lawsuit against Ripple, alleging that XRP was an unregistered security. This legal battle pushed the token off major exchanges in the U.S. and suppressed price performance for several years. In 2023, a partial ruling clarified that XRP is not a security when traded on public exchanges, which led to a recovery in price and its relisting on several platforms. However, the case wasn't fully resolved, and institutional sales of XRP remain under scrutiny. Ripple Labs still holds a significant amount of the token and periodically releases it, which introduces long-term supply pressure. Additionally, XRP's original value proposition, being a bridge for financial institutions, has seen limited adoption compared to its initial promise. The use of XRP in Ripple's on-demand liquidity product exists, but is concentrated in a few corridors and lacks widespread traction among major global banks. While XRP has delivered outsized returns to early holders, its future depends heavily on regulatory outcomes, institutional willingness to adopt its infrastructure, and competition from newer solutions like stablecoins, CBDCs, or other payment-focused blockchains. The asset no longer represents a pure technological or market-driven growth story. It's now more of a legal and operational bet. Any future upside will likely be slower, more uncertain, and heavily dependent on Ripple's execution and external approval. And moving to the top 4 of our list. From 2015 to 2025, NVIDIA delivered one of the highest returns among publicly traded U.S. stocks. In July 2015, NVIDIA was trading at an adjusted price of around 0.48 per share after stock splits. By July 2025, its stock is trading at $170.70. This represents a 354 times return over a 10-year period. A $1,000 investment in NVIDIA in 2015 would be worth around $34,000 today. The reason: the company captured a dominant share of the global GPU market, which became essential not only for gaming and graphics, but for machine learning and artificial intelligence. Starting around 2016, demand for data center computing began rising. By 2020, AI training workloads, including large language models, became reliant on GPU clusters. NVIDIA had a technical and infrastructure lead. It also locked in major customers: Microsoft, Amazon, Meta, and Google, among others. From a financial perspective, in 2015, NVIDIA's annual revenue was about $5 billion. In 2024, it's on track to exceed $120 billion. Net income margins have expanded significantly due to scale and high pricing power. The company now holds a significant position in major ETFs and institutional portfolios, and has become a proxy for AI exposure in public markets. Can it keep growing? Possibly, but not at the same rate. At current prices, a large part of the growth is already priced in. Valuation multiples are stretched compared to the rest of the market. NVIDIA is trading on the assumption that AI infrastructure spending will remain strong for several years, and that it will retain its market share. And there's some risks going forward, like customer concentration. A large portion of revenue comes from a small number of hyperscalers. Geopolitical exposure, because U.S. export restrictions to China could impact sales. Competition: AMD and custom in-house chips from Amazon, Google, and Microsoft are increasing. And finally, valuation risk. A slowdown in AI capex or overcapacity in data centers could trigger repricing. NVIDIA was one of the most profitable investments of the past decade. The market rewarded its early lead in a key hardware segment. Going forward, it still benefits from secular tailwinds, but at today's today's valuation, the upside is likely to be more limited and dependent on sustained execution. Now, the fifth and last top-performing asset is AMD. Between 2015 and 2025, AMD was one of the most dramatic turnaround cases in U.S. equities. In July 2015, AMD stock was trading around $2 per share. By early 2025, it reached approximately $112. That's a 56 times return over the decade. A $1,000 investment would have turned into $56,000. In 2015, AMD was in a weak competitive position. It was lagging behind Intel in CPUs and behind NVIDIA in GPUs. The company was losing money, its balance sheet was fragile, and it had minimal pricing power. However, under the leadership of CEO Lisa Su, AMD executed a multi-year recovery strategy focused on architectural innovation, efficient chip design, and regaining credibility in the data center, gaming, and high-performance computing markets. The core of AMD's turnaround was the development and rollout of its Zen architecture, which significantly improved performance per watt and allowed AMD to compete directly with Intel on both desktops and servers. By 2020, AMD had regained market share across all segments, including laptops, gaming consoles, PlayStation 5, and Xbox Series X both use AMD chips, and enterprise servers. The company also saw growing relevance in GPUs, though it continued to trail NVIDIA in AI applications. By 2023-2025, AMD was positioned as the main competitor to both Intel and NVIDIA, with continued share gains in server CPUs, EPY keyline, and attempts to build presence in AI accelerators. Its gross margins improved, free cash flow expanded, and the company reduced debt while returning capital to shareholders through buybacks. Still, AMD's upside from here is more uncertain. Much of its valuation now depends on sustaining performance in a highly cyclical and competitive semiconductor market. Demand for AI chips is growing, but NVIDIA maintains a significant lead in software support and ecosystem lock-in. Intel, while weakened, still commands a large installed base and is investing aggressively in foundry capacity. AMD sits in the middle, more agile than Intel, but without NVIDIA's dominance in AI infrastructure. Risks going forward include pricing pressure, potential loss of momentum in cloud and hyperscaler contracts, and exposure to macro-sensitive semiconductor cycles. The stock is also more fairly priced now relative to its growth outlook, meaning the type of returns seen from 2015 to 2025 are unlikely to repeat. AMD delivered exceptional results over the past decade by executing well in a competitive industry at a time of technological shifts. Going forward, it remains a solid semiconductor company, but no longer an underdog and no longer mispriced. Well, that's it, cousins. Stay invested.